All right, so last week, I think we got through all of the topic 9, I think. So today we're going to talk about efficient markets. We'll talk about financial statement analysis, and I think I can get through both of those completely. And so that next time we can talk a little bit more specifically about valuing a company, which is for this class is probably the ultimate part of the class. How do you actually value a company if you don't have a market price? Interesting idea. There are some techniques that work better than others. There are, if you talk to some professional portfolio managers, they might say, well, that's all silly hogwash anyway, because the markets are just the markets. I still like to do it. So chapter 8 here are the suggested problems, key terms for the session. Again, I'm going to work in some ideas around behavioral finance and technical analysis. I know that is for later in the semester. I think in 2 weeks. But it's good to try and introduce some terms earlier, and then just kind of plant the seed. So efficient markets, technical analysis versus fundamental analysis, and then mutual fund and analyst performance. Again, we could spend probably several weeks just talking about the behavioral finance, the behavioral psychology around mutual fund performance and analyst performance, but this is not a behavioral finance class. We do incorporate some of it, but that's not the main point. All right, so the efficient market hypothesis. So in security analysis, it really started with the idea, most forms started with an idea of a random walk. And if you're in statistics classes, they might call that a martingale series, or a martingale series with a drift, where the random variable is, let's say, the return on the stock. So if you take the difference of return from period 1 to period 2, on average, that should equal 0 in the long run. And it should have, it should be uncorrelated. And that's usually how most or many studies in securities pricing, how they operate. They assume that you have an expected return. The returns in period 1, period 2, period 3, so on and so forth, are uncorrelated. They are independent. And that the variance is constant through time. And so throughout all of this academic work, they came up with a kind of a holistic view of things that said, well, we can go a little bit further than that and say that if we think about it in terms of information, we can say that security prices reflect all available information. That's called the efficient market hypothesis, or EMH. So if you study further in academic finance departments, they might just say EMH, and you just need to know what that is. Now, there isn't just one form of efficient market hypothesis. There are 3. There's weak form, semi-strong form, and strong form. And I like to go through these starting with the one that's the easiest to disprove. And it sounds like I'm going to be critical of them, and I will be, but that doesn't mean that they should be just thrown away. Without using efficient markets hypothesis techniques, and I think I've said this before, broker-dealers would not be able to price and hedge their products using market transactions. So there is value to it. But also, if you're thinking about it from a standpoint of an equity or a fixed income bond, corporate bond investor, there are problems that need to be at least understood and appreciated. So strong form EMH states that all information, public and private, is currently reflected in security prices. And so let's consider a case where company A is going to acquire company B. When this happens, typically it is done through closed door negotiations. Only a few people really know that's what's going on, or a small group of people know what's going on. So it's going to be typically the leadership teams and select groups within each company, as well as the investment bankers that are working on the deal and any advisors that are working on the deal. And so strong form EMH would mean that there is no real benefit. If company A is acquiring company B, and it's going to be a stock transaction, there would be no benefit to me before this is announced for me to go buy company B shares and short company A shares. Now, just you can use the raise hand feature in the Zoom, or you can comment in the chat. But does anyone see a problem with this assumption, with this hypothesis? No one sees a problem with this. It's illegal, okay. Yes, it is illegal. What if it wasn't illegal? Would you think that there are any issues with this idea of efficient markets hypothesis? It would be unfair. Sure. So you're saying that the strong form EMH does not make sense in real life. Okay, I agree. And most academics agree as well. I mean, it's illegal. There's a good reason why it's illegal. Most countries that have well-developed financial markets and stock markets have some kind of law written forbidding the use of insider information, trading on insider information. And people go to prison, and people have gone to prison. Martha Stewart went to prison for insider trading. I think that she was successful at getting it reduced. I think the actual charge was a reduced charge. I can't remember because of the relationship she had with her broker. And so I think that there was some kind of reduced charge, which meant that she didn't have to serve as long in prison. Fines of up to $5 million and or 20 years of prison for each willful violation. So there is a problem there. All right, so strong form might not be the best representation of reality. Let's talk about semi-strong form next. So semi-strong form is similar, except only public information, only information that is currently publicly available is reflected in security prices. And so it accepts that trading on private information, material, non-public information, is what the legal term for it, can lead to what are called excess returns. Returns in excess of what you should get if everything is trading on the same Sharpe ratio, which it would be in an equilibrium state. And so after a significant event or release of information to the public, the share prices of that, the related companies, the relevant companies, immediately change to reflect this information fully. And so that's the idea of semi-strong form. In reality, that is not exactly what happens typically. When there is a disclosure of significant information that materially changes the prospects or financial health of a company for at least the near to intermediate term, there is going to be a knee-jerk reaction. But what some academic papers have revealed in studying these types of events is that they're typically followed by a trend for the next 1 to 2 weeks at least in that same direction. And it tends to be a little bit bigger and longer if it's a negative event or negative impact as opposed to a positive impact. So let's look at an example. This is one that I remember very, very clearly. Bank of America announced in 2014 that it would be taking a $4 billion with a B, $4 billion US dollar non-cash charge, a write-down, tied to capital. What had happened, and this is all publicly available information, Merrill Lynch had issued a structured note, so a structured bond where the interest payments were only made under certain conditions, or if some indicator was above or below some threshold, or tied to something else. These are usually issued as a hedge against a business dealing with a client. But Merrill Lynch had issued a structured note some years before, prior to the merger and acquisition of Merrill Lynch by Bank of America. And when the note came, I believe it was when the note came due, the team in charge of, I presume that the accounting team in charge of managing capital from an accounting standpoint realized the problem, had to report it up, and then they realized this was a big issue, and they had to essentially restate their accounting of capital in the form of taking a one-time charge. Now, this might seem, okay, well, it's a one-time event. It also meant that they had to resubmit their capital plan. Banks in the current regulatory environment, this is tied to the change in regulatory environment from when this note was issued to 2014, which was substantial. In this current environment, banks have to submit their capital plans to the Federal Reserve for approval, meaning we want to raise dividends. For a large bank, we have to get approval from the Federal Reserve. If we want to buy back shares, we have to get approval from the Federal Reserve. And those approvals are dependent upon many factors, but one of the most important is how we perform as a bank, if we were managing a bank, in the annual stress test process. And so Bank of America had to go back, restate their capital, rerun all of their stress test results using their new estimates of their capital at that point, resubmit it to the Federal Reserve, resubmit their capital proposal, their capital plan to the Federal Reserve, and hope that they would approve it. So this was announced before the market opened on Monday, April 28th. And when the markets did in fact open, there was a knee-jerk reaction, and most people call it gap down. It opens below the prior day's trading range, and it never gets back up into the prior day's trading range. So here's from Yahoo Finance, Bank of America stock price from December of 2013 to November of 2014. If it's difficult for you to actually see where April is, there's April 28th right there, a very clear gap down. And then look at the trend that continues after. Now this is just one example. There are many examples that are out there. and it's one that's actually studied in the academic literature, that some researchers try to estimate how big of a change is it, and what's the continued, the continued drift for how many days thereafter. So semi-strong form EMH still has issues. Granted, they are much smaller, they're less egregious than the ones for strong form EMH, but it still has problems when it faces reality. All right, last form, weak form. Weak form EMH states that historical security price information is currently reflected in security prices. Another way to say that is the history of prices, the history of, if you look at a share price, its entire history of prices is currently reflected in the price today. And it has no predictive power on the future path of the stock price today. So I have a question. Do you think stock prices have momentum effects? If a stock is going up, is it going to continue to go up at a similar pace? If a stock is going down, is it going to continue to going down at a similar pace? GameStop notwithstanding, I don't know. Yeah. So one person says yes. One person says no. So some people believe this, some people don't. Nobel laureates, recent Nobel laureates believe this, and recent Nobel laureates don't. In fact, shared Nobel laureates in 2013 disagree. And I think I've mentioned those two before, Robert Shiller and Eugene Fama. Oh, now we're getting into a little bit more nefarious talk. People with big followings can influence the price of a stock, given the advice they give. Yeah, that's kind of bordering on market manipulation, which is also illegal. The Kramer effect, yeah. Even absent that, let's say there is no market manipulation. So first of all, every time we talk about one of these forms, as we go from strong form to semi-strong form to weak form, so everything that makes, that would typify weak form is included in semi-strong form. And all the assumptions included in semi-strong form are included in strong form. So each one is essentially nested in the next one up. So there's a comment, I don't think that alone accounts for all the stock's behavior. No, I agree. I don't think that's the main contributing factor, but there is some credence to things like momentum effects, to things like chart technical analysis. If there weren't, then there would not be an entire association called the Market Technicians Association that thrives with growing membership every year and growing charter holders, the CMT designation, who are also employed at many major research firms and research groups across the financial services industry. If weak form EMH were true, all of these individuals would not be able to make money, and yet they do. They do a lot of graphing, and based on how graphs of prices look, they can oftentimes get some kind of a read on what it looks like we're having a consolidation period, and it's going to break out of the resistance or the support. And there's a comment that could just be normal human behavior trying to make sense out of a system it doesn't understand. Maybe, but if it's something that's repeatable and can be gleaned through chart technicals, then that would be an argument against weak form EMH being a valid state of the world. I'm not saying it's the only way that stock prices move or security prices move, but weak form EMH does also have some drawbacks. They are, again, less egregious than the others, especially strong form. So some significant efforts have been made by fund managers to get access to information. And they mentioned these two in the book specifically, and there are many more that you come up with. I mentioned Martha Stewart issues, which again, I think that her charge was a reduced charge from insider trading, but I think that her broker got a much stiffer penalty. But Raj Rajaratnam, Galleon Group, used to manage $6.5 billion. And he essentially would solicit information from insiders. He served 8 years in prison, which his sentence was originally 11 years. Don't worry, he's fine. He has a really nice apartment on the Upper East Side of New York, of Manhattan. SAC Capital, Stephen A. Cohen. He is a majority owner in the Mets. SAC Capital, not Stephen Cohen. SAC Capital, pled guilty to insider trading violations and paid fines of $1.8 billion. Stephen A. Cohen's penalty was he was not allowed to manage outside money for 2 years. He didn't get any jail time. And if you want to see something that's just defies belief, pull up his deposition and watch his responses to insider trading and what it is and did he do it. The $1.8 billion, some of it was forfeiture of capital. That's how they came up with those numbers. On the level of I didn't know I couldn't do that, I can't remember his exact response. I don't think it was exactly that. It was, I think, more of, well, it's unclear what you really mean by insider trading. But that's something that's, beyond that probably falls under, a law course. All right. Technical analysis versus fundamental analysis. Technical analysis is a pretty interesting field within financial analysis or security analysis. They don't care about fundamental value. They don't care about company's profitability. They really only care about, well, what's the path of stock prices? And it seems like, oh, well, that's just a very simple, you just put it on a graph and draw lines. There's a lot more to it than that. There's shapes of a stock price trajectory. There are things like oscillators. There's moving average things. There's something called the MACD, which is a very popular technical analysis tool. There are different filters. There's something called a stop and reverse oscillator. The easiest things to think of are resistance level and support level. Resistance level means it's a point where the stock price is having a difficult time breaking out beyond, above that resistance level. So stock price goes up or an index goes up, once it hits that level, the market tends to kind of have a difficult time getting above it. Support level is where if a stock price or an index is falling, there's a level where it offers some support, and it could be psychological. And so it will not really go below that. If it does, it won't be for very long. And there's lots of things. If I go back to anyone have a specific stock ticker that you like? Not GameStop. SPG. They might actually have some chart technicals built into this. So candles. There are certain candle formations that are used as technical indicators. So if you see that the open and close are very similar to the day's trading range, the best example is they are exactly the same as the day's trading range. So it opened at the low or the high and closed at the other end. That is a strong chart technical indicator. So if it's a tombstone that's down on the day, like this one, that's a negative sign. If it's a tombstone that's up, that's a positive sign. So 2 positive tombstones in a row. They might call it something else when it's up. And here, this one's called a falling star. Either a falling star or a hammer, I can't remember. Where you have the open and close very close to one end of the day's range, the day's range being the line. These are all chart technical ideas. And what's the shape of that candle on that day? That gives you some insight as to the mood of the market, the mood of the investors who are trading that stock. And someone else said TRCH. See TRCH. Oh, a penny stock. Come on now. Thank goodness I've got this on log scale. That looks like a tombstone right there. See that? Or a green tombstone, which would be something else. Can't remember the name if it's green one. It's up. That would be positive signs. You buy it. Oh, here's a great example of one. These are chart technical ideas. Let's see if they have any. Indicators. MACD. Oh, that's not a good sign. Better sell now. Don't know. RSI, relative strength. That bottom one here. And this is reverse. If it gets up to 80, that's a sell signal. If it gets to 20, that's a buy signal. So 80 means overbought, 80 or 70. And 20 or 30 means oversold. See? Oh, here we go. Accumulated distributions. Yeah, they have a lot in here. The Arun indicator, Arun oscillator. So here they have them all here. This is the kind of stuff you need to learn. Don't quit your day job. Unless you really want to do the CMT process, which there are opportunities if you do. I'm looking for one stochastic oscillator. And they've got a lot in here. They've expanded it from last time I saw these. Stochastics, there we go. Yeah, that'll work. You have the slow stochastics and the fast stochastics. And if it's oversold, here you go. The stochastics say it's oversold. And they all have very, if you go and read the details about how they're actually calculated, you can calculate these on your own. Is it reliable? Not necessarily. My mentor used to say, it's one of those things where you don't want to bet your whole investment on that being correct. But if the fundamentals and the technicals agree with each other, that usually is a real winning bet. So if you think a company is a good company, you think their valuation is good, you think that they have good prospects, and the technical support, hey, this is probably a good time to buy, those types of investments oftentimes are the most profitable ones. You can't time the markets. Yeah, it's extremely difficult to do. Someone who times the markets perfectly for years in succession, I would be highly suspicious of whether or not they were doing something illegal, like insider trading. Very difficult. So that's technical analysis. What's fundamental analysis? It's researching a firm based on how they're performing. How is their business model doing? How are their financials, or financial reports? What does that tell you about the health of the company? Have they become too leveraged? Should they use more debt? Which has been an argument from investors for Bed Bath & Beyond for decades. The founders of Bed Bath & Beyond, the two founders were men who were, I believe that they were young during the Great Depression. I'm thinking teens. And so they did not want any debt. And so Bed Bath & Beyond, I think it was about 3 or 4 years ago, issued their first bond ever. But it reduces the cost of capital. Debt capital is a lot less expensive, and it gets than equity capital, and it has a tax deductible feature to it. So we can look at ratios: price to equity, price to book, price to sales, price to free cash flows. Free cash flows to the firm model. This would be going towards trying to get an estimate of the enterprise value of the firm. Free cash flows to equity. Strip out the cash flows that are going to go to debt, servicing debt. One that is, I don't recommend in terms of accuracy, but one that really helps when trying to, and I'll talk about this next week, I'm trying to decide, okay, well, what are the driving factors to the price reaction? Dividend discount model. It's awful in terms of actually, estimating a value for the price of the stock. But when you see a stock move, if you think about the dividend discount model, it tells you what the investors, ideally in a perfect world, are indicating about their belief of what's happening to the company and the prospects given the economic backdrop. So our market's actually efficient. So many aspects of factor analysis. Recall those versions of the CAPM. And CAPM is important, despite its drawbacks. They indicate that there are problems with market efficiency. Returns over short term show compelling evidence of momentum effects. However, in the longer term, those effects tend to reverse and lead to a more efficient market pricing mechanism. But we still have the price to earnings effect. Low PE tends to outperform in the intermediate term. The small firm effect, small companies tend to outperform. The neglected firm idea, so less well-known companies are typically smaller, also tend to outperform. Now, all of these are all tied to value investing ideas, and they don't always work. And for the last, other than the last 12 months, the roughly 10 years before that, value investors had a rough time. They were still earning returns, but they were underperforming the market. They had a difficult time keeping pace with just the S&P 500. So in this chapter, it's chapter 8, I can't remember. They also talk about mutual fund and analyst performance. And I think it's worth talking about, because it does tie to these ideas about can you time the market? Are markets efficient? Are good investors consistently good investors? And so research analysts, there are studies that have been done on how they rank their companies, how they rate them, and they have a strong bias towards buy ratings. And these researchers are also impacted by what are called behavioral biases. There's an anchoring and adjustment bias. And so the best example that I like to give about the anchoring idea, so a behavioral psychologist in his studies, studying the way that people make decisions, he would have people, he'd say, okay, I want you to think about the last 2 digits of your Social Security ID. It is a randomly generated government ID. There are some significance to the first few digits, but the 2 digits at the end are completely random. After, he said, I want you to remember it, write it down on a piece of paper. Then he asked them to tell him how much they would pay for each of 5 items. One was a bottle of wine. One was a wireless key. This was, 20 years ago, I think. Wireless keyboard and mouse. A few other items. The 25% highest last 2-digit Social Security numbers well outbid the 25% lowest last 2-digit Social Security numbers. That's an example of anchoring. He anchored their thinking simply by having them think of a random number, totally unrelated to what he was asking them about. And so if you can anchor someone by something that's totally unrelated, think about if they are thinking about things that they perceive to be related. And then as new information comes out, analysts tend to be slow to adjust their estimates. They'll adjust their price target slowly until it's like, okay, well, I got to make a big adjustment now. Mutual fund managers. So active strategy fund managers get paid for their work. So it would make sense if that means that they tend to outperform the S&P 500 on average in any given year. In reality, it's actually very difficult. And there have been studies that show that their performance tends to rely on whether or not smaller companies have outperformed or underperformed the S&P 500. So this one paper studies the returns of mutual funds based on historical performance deciles. So the top 10%, 80 to 90 percentile, all the way down to the first 10%, the 10% worst. One of the things that this researcher found is that the persistence and outperformance, the ones who consistently outperformed, it tend to be explained more often by cost reduction, expense management. Again, the John Bogle idea. Just reduce the costs. No load funds. Reduce the expense ratio. Index everything. Also, most of the excess returns seem to be pretty random, with the exception of the top 10% and the bottom 10%. But if you look at these, even the top 10% after a few years, it looks like they end up just being average as well. And this is average monthly excess return. I think that's, I don't know if that's excess return over the risk-free rate or not. And here's the worst 10%. And then again, after a few years, they catch up to the rest of the pack. Which maybe there's something to just, don't worry about market timing, just buy the haystack. All of this points more and more, in my opinion, to following John Bogle's idea. All right, any questions, comments, concerns?
Hi, Professor. So I actually used to work directly with mutual funds on behalf of broker-dealer clients, and I had a chance to read a lot of historical annual returns. My observation was that the funds that were consistently charging the higher management fees were also long-term the consistently poor performers.
Okay. Yeah, I don't know what to say there. Do you remember any of the fund names?
Some of the ones that I was working with particularly, I know I couldn't remember who the highest percentage of fees were, but I know Barings comes to mind immediately. And there's a couple of others, but I'd have to go deep into the think tank. That was about 5 years ago.
Yeah. Okay. Yeah, Barings has an office here. So
please don't tell him I talk bad about him.
Yeah, it's a tricky business. I mean, the more and more I every time I read something, it just reinforces that idea about the John Bogle idea. I mean, the guy was a smart guy. But I mean, there are funds out there that have been around for a very, very long time. Dodge and Cox is one that comes to mind. I think they've been, I don't know, they've been outperforming the market consistently over the last 10 years, but historically they did very good up until about 2009. Some other ones, Dimensional Fund Advisors, DFA. They also have a presence here in Charlotte that I think is growing. The founder of DFA, his name is David Booth, as in the Booth School of Business, the University of Chicago. They have an interesting philosophy. They believe in efficient markets, but then if you look at their investing strategies, it's as though they don't believe in an efficient market, so it's peculiar. But yeah, there's there are a lot of funds out there that for the last 5 to 10 years has been a bit difficult for them to outperform the market indexes. Thank you for sharing that. That's it's always useful to hear, others, students, participants, students' experiences, observations. So I appreciate that. Thank you. Any other questions, comments, concerns? Well, I can remember the highest fee I saw was a front plus backload of 9%. That's huge. Yeah. So take away from this for your own personal investing, avoid front load, back loads, and look for lowest expense ratios is the best advice that I think any financial advisor would give, to the point that someone, John Bogle, made a very sizable and successful company based on that idea. So, okay. Let's